Welcome to How to Money with Cole and Cole.
I'm Cole.
And I'm Cole.
We coach people every day on their money and how to plan for the future.
As financial advisors, we're here to have an honest conversation and educate you on how to money, intentionally and passionately, to hit your money goals. And we'll throw in some sports talk along the way.
Our mission and goal of this podcast is to improve your money journey and help you create the financial life you deserve.
So let's talk money.
And sports.
Welcome back to How to Money with Cole and Cole. I am your host, Bailey Ashbrook, a licensed advisor at Central Financial Group and also a best basketball player in the office.
we yet to see about that, but I'm Cole Peterson, partner investment advisor at Central Financial Group, and my Cubs still stink, but Broncos are 2-1. Excited about that.
I'm Cole Jaskey, financial advisor, wannabe golfer, and I would say I'm a wannabe podcaster. So.
Yeah, we're working on it.
Yep.
Hey guys, I'm Caleb Westall, producer of the How to Money with Cole and Cole show, here with Spin Market. The Panthers finally won a football game, and it's only 3 weeks until the opening day of the NBA season, so I'm excited about that.
NBA guy, I forgot about the racing at NBA.
I know.
Yep.
Yeah. I know. No. Yeah, my Steelers are 1-2. Not a great start to the season. So our best player, defensive player of the year, is hurt. Could be out majority of the season. So
It could be worse. You could have Baker Mayfield as your quarterback.
Yeah.
So
Well, he has Mitch Trubisky. I don't know if that's much better.
Yeah, I wouldn't consider that an upgrade.
No.
Do you guys do fantasy football?
Oh, yeah.
How's that going?
My team's 2-1. I'm doing all right. Yeah. Nobody ever wants to hear about your fantasy football team, though.
Mine's not very
No.
good. I don't want to talk about it.
Okay, see, competitive. But today we're going to talk about what is a bear market, all things opportunities in a bear market, tax loss harvesting, just some good topics because I think it's a big conversation right now, the market, what's going on in the market.
With everything that's going on, there are some things that you can take advantage of. And I think people don't realize that when the market is down, that's not such a bad thing, especially for younger people, people not withdrawing funds from investments, things like that. So it's not always a bad thing. Rising interest rates, always not such a bad thing. You just got to know how to utilize the tools.
Yeah, I think, it comes back to, we always preach having a plan, right? Right. And these are one of the times it's easy to stay and talk about your investments and your strategy when everything's, going up. But in all reality, 1/3 of the time, the market's going down, so in all reality, we're going to have to deal with this and younger, clients, older clients, there's going to be multiple more times. So I think you got to look at it as, take the positives with what the market's given us and make sure, and it's a good time to revisit your plan. Yep. Make sure that your strategy is, you're comfortable with what you have and you're working with your professionals to
Be prepared.
to wait through these times.
Let me ask this then, because I'm sure Caleb might not know this. What is a bear market when we say that?
Right. So a bear market is when the major indices are down over 20% from their high. So the S&P 500 hit that yesterday for the first time in 2022. The NASDAQ and the S&P 500 have been down more than that. And a lot of people use the Dow as a measuring point, but the Dow is only the top 30 companies in the world. So it's not a great measuring, is in the world or U.S.?
U.S.
In the U.S.
but most of the time the S&P is that we use as like if we're comparing indexes, we're going to use the S&P 500, which is the largest 500 companies in the U.S. That's, I think, a more accurate reflection of where the overall U.S. market is doing. But depending on who you ask, that could change. Right.
But the top 30 companies being down 20% or more is kind of, it's not shocking by any means, but it definitely raised some headlines because the Dow hadn't hit that point until yesterday.
Right. And we were talking about this yesterday. It happens. Like there's an average bear market time. I think it was 280 some days. This does happen, but like we said, there is opportunity. So Cole Jaskey, maybe talk about the opportunity you kind of see for your clients and things you kind of help them with in a bear market.
Yeah. Obviously, first and foremost, you put it, in terms of time, right, for people. And that's where we always got to get back to the context of how long, and if you're looking at current money invested, are you going to be invested? And making sure people look at their timeline and say, oh, I've got 10, 15, 20 years. If they do, and the longer the time horizon, it's probably an opportunity to say, hey, yeah, I don't know if, now's the best time to buy. But if you have dollars available or money you were going to be investing at a future point, or you had earmarked to go into your retirement portfolio, investment portfolio, it's probably a good time to look at start adding that in. I mean, we're 20% cheaper than what we were, at the beginning of the year. So is that exact bottom? Who knows? We're not going to ever try to predict the bottom, but that's one area I would say. Number two, and this is something, most financial advisors should be talking about to you as clients, is tax loss harvesting. For the first time, I would say with the quickness of the volatility, we probably do have some losses, capital losses or short-term losses that you can offset some either capital gains or different scenarios there.
Just stop you real quick. Just explain real quickly what is tax loss harvesting for some listeners who might not be familiar with that.
Yeah, so I got an example. This is kind of I would say a case study of something I've been going through recently. Obviously, we never give out any clients' names or information here, but I had a client that recently had a $50,000 capital gain he realized from the sale of a piece of real estate. Mm-hmm. So, and we went through, and it's a good and a bad thing, right? When you made some money, but now you have to pay capital gains tax on that. So we went through, and he's got a significant portion of his wealth into individual equities and stocks. And we had made some transactions last year, and he does have some capital losses that we can take. So we went through his portfolio and looked at some of his losses, and we were able to take about $53,000 worth of capital losses to not only offset that gain, that capital gain, as well as $3,000 of his ordinary income. That saved him, on the capital gain side, about $7,500 in federal capital gains tax by doing that. And the other thing is we're able to, reestablish. He immediately put that money back into stocks, not the same stocks. You have to wait 30 days if you want to buy the same stock, but into stocks similar to reset his basis. And hopefully when the market does rebound, in which he's a long-term investor, understands it's a time game, not a short-term game, that his gains will be multiplied by buying at that 20% discount and realizing the tax benefit.
Yeah, so you can take advantage of a down market just like you can of an up market. Just to clarify a couple things for the listeners, you can't do the tax loss harvesting in an IRA. IRAs are already tax deferred, so you have to do this in a non-qualified account, like Cole said, brokerage, stocks, bonds, mutual funds, something that is not tied to an IRA. And then I wanted to go back to the bear market because our average bear market is typically 289 days. We looked this stuff up yesterday when we were preparing for the podcast. Not that I knew that off the top of my head by any means. Since the top of the market in January, we're on 245 days. So I'm not saying that it's only going to be volatile for the next 45 days and we're going to be out of the bear market, but it's like we've been dealing with this all year. It's nothing new. So it's just hit that point where we thought it was a good topic because we hit that point yesterday.
Right. And there's a lot of things going on in the economy. Another one is Fed's raising rates, and we kind of talked about that yesterday as well. And Cole P., you can speak on this too. Like sometimes when rates go up, there's an advantage. Like money markets are higher than if you're sitting on cash. Maybe explain that as another opportunity for people.
Right. Just about a year ago, the best rate that we could find was on a 5-year fixed indexed annuity or fixed annuity, at 2.25%. Now that rate is 4.5%. So people can take less risk and make more guaranteed return. On the flip side of that, if you have any credit card debt, if you have anything that's on a variable interest rate, which means that it fluctuates with what the interest rates are doing, you are going to pay more interest. So if you have cash sitting on the sidelines and you have credit card debt, something that has on a variable rate, you should pay that debt off. Another thing that has happened recently is mortgage rates have changed. We had a mortgage historically, mortgage rates have been around, 4, 5, 6%. And they were at the lowest last year, 1 year ago, about 2.85%. Right now, they're back up to 6.5%.
Well, we were talking about that yesterday because people still, we're so spoiled the fact that we were around 2 to 3%. We're like, and now we think 5, 6. We're like, wow, that's just insane. But that's actually not as high. I mean, it's higher obviously than 2, but back in the day, I mean, 8 was. I mean, it's just funny how times have changed.
I've heard so many people say, "Well, I had a mortgage at 18% when I was a kid. You know, when my first house was 18%. I can't even fathom that." And so so in relative context of like we're still at a lower rate environment, but it definitely changes. You know, and it's going to be interesting to see how that evolves into the housing market and different things of where that goes. But you need to be having these conversations. I mean, that's I think if we kind of have the headline of this podcast, make sure you're having those discussions of thinking through, some of those different scenarios of what you're doing.
I just think it's so important to sit with a financial advisor. Obviously, we're financial advisors. We're going to say that, but stuff is changing so much. Inflation, it's just all of it combined, the market, the bear market. Caleb, did you know what a bear market was?
Not until yesterday.
Yeah, that's what I'm saying. Like, it's just so important to educate yourself, and that's what I think you guys will say we love to do. So there's also more opportunity going on, but we'll take a quick break, and then we'll get back to that.
This podcast is produced by Spin Market and Digital.
Located in Fort Dodge, Iowa, Spin Market's highly skilled team can help you increase your market by updating your website, improving SEO, designing advertisements, and producing podcasts that will grab the attention of your market.
Contact Spin Market today for all your digital marketing needs at digitalagent@spinmarketwith2ks.com or call us at 515-302-8026. And to learn more, visit our website at www.spinmarketwith2ks.com.
That's digitalagent@spinmarket.com or 515-302-8026 or visit our website www.spinmarketwith2ks.com.
Welcome back. Real quick, want to reference this. It's September 27th. My husband's birthday is in 2 days. Good thing I looked. But this will air October 4th. The market and everything changes quickly, so we just want to reference that real quick. But how about them Broncos inching by this weekend, Cole P?
Yeah, they pulled out a close one, unlike the first week where they lost a close one to the Seahawks, and then they squeaked by the Texans at home. So I'm not. I was really, really positive when the season started.
Unlike the market.
Are you less positive now?
They don't look very good. The defense looks great. The defense is number one in the league, just like they were last year. But the same problems we had last year. Our quarterback play hasn't been very good.
The Russell Wilson hype's not been up, lived up yet.
I haven't watched a minute of Broncos football, but when you look at the scoreboard, you would say that offense seems really stagnant so far.
Right.
So
right. It has been bad, and he's been under a lot of pressure. The offensive line has played terrible, so it's not all on Russ. But hey, they're 2-1. So in the
wins
NFL,
are wins.
The NFL is of any other league in the whole world. Just winning is hard. So
less games got more important wins.
Yeah. How about your Hawkeyes? They're getting back on track. 3-1. They won at Rutgers. That's pretty good.
Well, the defense helped with some
scored
scoring.
14.
I was
they're outscoring the offense. I think this year. So
I told Luke, I'm like, can a punter be the MVP? You know what I mean? Like, he's out here killing it.
Yeah,
okay,
Big Ten player of the week.
Yeah.
Did anybody see the butt punt?
Yes.
Which team was that? Was the
Dolphins,
wasn't it? Yeah.
Oh, I didn't see that.
it's kind of circulating the internet.
The Bills got a safety off of the punter for the Dolphins, punted the ball into his protector's butt.
Oh.
His protector came backwards too much, and he kicked it and hit the guy off the butt.
They were in the
and
back.
went out
They were in
zone.
the back of the end. They were in the end zone punting, so he had less room, and then he just backed right into him.
Yeah, it's kind of becoming a meme all over the internet right now.
But guess what? The Dolphins are only one of 2 3-0 teams in the
that's
league.
right. I know.
So
Who's laughing now?
Joke's not on them. Them and the Eagles
Of all teams, right?
So here's your Super Bowl. Dolphins and Eagles.
Yeah.
Who would have picked that to be the only 2 teams left
I know.
undefeated after 3 weeks?
Nobody.
That's great.
Not me.
Cole J, you're quiet. NFL's not going well for you?
Yeah, I've already, my Steelers are 1-2, quarterback suspect, quarterback play. Defensive MVP is hurt, probably for most of the season. So I don't know. We'll see. We're a good organization though. I'm optimistic. We'll still be competitive. So we'll see. I don't think it's our year to go too deep, but
somehow Tomlin will get to 10-7. You know he will. He'll somehow get the team to 10-7, get in the playoffs. They probably won't do much, but he's such a good coach. And I know Najee Harris has been a little underwhelming, and I think he's been a little nicked up too. So
I think I saw a thing that was like Mike Tomlin hasn't had a losing season in like 15 years or something like that.
I think he's only had one in his whole career.
Yep.
That's crazy.
Yep.
Yeah.
And hey, at least you have Kenny Pickett as your backup because you know the future's bright. Like I got Baker Mayfield as a starter, and we have Sam Darnold for a backup, so it could be worse.
Yeah, I love the Steelers franchise. Though it's just
they do things right.
They've stuck consistent. You look, they've had like 3 head coaches in like 70 years. It's not something crazy. So it's ridiculous. They commit to their to their coaches, and the organization has they draft good players and have good people in that organization. So it's a cool franchise to follow, and 6-time Super Bowl champs.
I knew you were okay. We'll get the boys off the football horse here. So we're going to talk more about the market, some opportunities. Obviously, there is negatives to a down market. We understand that. But there are opportunities, and we like to help our clients pivot. And Cole, you have a pretty good example of how you guys kind of did that.
Yeah. So I'll give a real-life example, and the only client information that we can share is myself and my wife, Molly. So Molly had an old IRA that we had rolled over from a 401k, and it was just sitting in an IRA. Had been all the way up to about $32,000 in value, and recently had dropped below that, below $20,000. So we converted it to a Roth IRA. And you would maybe ask why you would do that at that point, because you pay taxes on the amount that you can convert from an IRA to a Roth IRA, not the value at the highest value or the lowest value. It's whatever the amount is at the time. Well, it was at its lowest value. I was planning on converting it at some point anyway, and I was like, well, what time is better when it's at the least amount that it's ever been? Not saying it's not going to go lower, but I convert that. We're going to pay taxes on that money this year, which we're prepared to do. And then we never have to pay taxes on that money ever again. And it can grow to as big as it's going to grow. And when we are over age 59 and a half, we can take it out tax-free.
Yeah.
So it's an opportunity for people. If you have a smaller IRA, or if you can pay some taxes on some IRA money, there is no income limit on a Roth conversion. So you can make $1 million a year, you can still do Roth conversions.
Right, because some people are limited to putting stuff in Roth. They make too much income, so they might have an IRA and they might have extra money, and this might be the time to convert it because they do that anyways.
Yeah, have just a heads up to some of my clients. You're going to be hearing from me about this idea because I made a list yesterday, so I'm going to be calling out to some people.
I love Roth money. We know that.
Yeah, Bailey's a big. She's always a huge advocate of the Roth. So
me too.
Yeah, but again, it comes back to the conversation. You need to be having those ideas, and that's where I think there's many opportunities that this market's given us right now. So you can look at it one of two ways. You can be a Debbie Downer or say, hey, what are the opportunities? What are the things we're going to do moving forward? And this is another one. And I think another area or thing we've been talking to about clients is rebalancing, diversification. Obviously, you hear that word a lot with us is diversifying. And I gave that tax loss harvesting example. That's a prime time of harvesting some losses, and then to make sure your portfolio is diversified. Sometimes crazy markets will also make you more aggressive, more conservative. This is a good time to recheck that, and by default, you're making some changes so you can look at, is there areas I need to add to or opportunities? Maybe you want to get rid of some things that have underperformed, and that's another area that I think with opportunity that the market's given us.
With that diversification, another thing that rings true, and I talk to clients about this a lot, is just for example, if your client didn't have that money in non-qualified, he wouldn't have had that option. Say he had all his money in a SEP IRA, he was a farmer. What if he put all his money in a SEP IRA? He wouldn't have that option to do the non-qualified account tax loss harvesting. So I talk to clients about that a lot because people think, oh, I'm putting money in my 401k. That's fine for retirement. And I talk to people about, well, yes, that's great, but you also need to create other accounts so you have different strings that you can pull as you get into retirement and maybe even before retirement if you want to retire early. So not only diversification with investments, but diversification with where you have those in different buckets. You talk about a lot about buckets. Yep. Have different buckets of money that you can pull from. Don't have everything in one bucket because then it doesn't give you the options that you need.
And that's why some people, they're like, I don't know if I'm old enough to work with an advisor. I'm pretty young. We're not even close to retirement. But these are strategies you can set up at an earlier time so you have these buckets and they have enough money. And then you can utilize these strategies in times like this and have opportunities, which is another, I can't remember the statistic, but we talked about people getting out of the market right now. Like, what would you tell to people? Because it is a fearful time for some people that they pull out, they sell at the low, and it ends up hurting them instead of riding this time out.
Yeah, I have a phrase I guess I use all the time, and it's better to be in the market than to time the market, right? And especially if you're a younger person, I don't think you can find a stat out there that shows trying to time versus just time in the market that's going to show that you're going to do better. I would say the best professionals in the world that all they do is manage stocks and buy and sell stocks, and they don't get it right, nearly 50%, maybe 50% of the time. How are we supposed to do it? And that's where it's letting your plan dictate the decision making, right? Letting your plan, your goals and objectives, that should come first. And then you go back to, okay, is this individual transaction, how does that impact to those? And that's sometimes you got to put it into context of where we're at, what we've done the last couple of years. We've had a lot of gains. So if you had money in the market the last 3 years, yes, we've given a little bit back, but we're still net, up significantly over the last 2 years.
Yeah. So, and I won't steal your thunder because I know you have the stat at top of mind, but time in the market, and what Cole's going to explain is if you had got out of the market and you missed the top 10 days of the S&P, so you were trying to buy and sell and time the market and you happened to do it wrong, you would have ended up, losing out on so much.
Yeah, so what he's referring to, there's one of the vendors or fund companies we use they did a report, and this I think was accurate up to 2020. So they were just using the S&P for, I believe, a 20-year period, and they were showing a 1-year period there, and they were showing trailing of 2020. If you missed the top 10 trading days in that year, you had a negative return. So say you just own the S&P index, that's it. You own the S&P 500. And you miss the top 10 trading days, you'd be really unlucky to pick the top 10, and those are the days you were out. But what that's saying is most of your gains, especially if you're an equity investor or a growth investor, come on very few days in the market. And it's how do you pick those days? It's a very, very hard thing. It's almost impossible. Yeah. So that's the thing. And then you go into missing the top 30 and missing the top 50. The numbers get significantly worse. So it's easy to say, hey, let's sell and get out. But then you're going to go, when do we get back in?
Right.
Who makes that decision, right? And a lot of times we're going to be a component of riding it out. I mean, people hate to say that, but that's where we have the discussion ahead of time of like, hey, if down market happens, here's how it looks on your portfolio. Are you comfortable with that? If not, we need to de-risk a little bit. If they are, then we go through, and then someone comes to us. A lot of times, you talk. I mean, I'm sure you could speak to this. You're having many of those conversations right now.
Right. So I kind of talk to people along those lines, like, hey, this happened 2 years ago in 2020, and what happened? And this happened in 2009, and what happened? Do you think the stock market will be higher or lower in 1 year from now? Most people will say, oh, well, higher. Okay, then, are you going to use any of this money in the next year? Well, no. Okay, then why would we take a chance and sell out? And if we're wrong and the markets, continue to go right back up, then you're going to be out. So same thing that Cole's saying is like, if you are not planning to use this money and you don't need it in a cash position, and you can stomach the downfall, it's better to stay in.
Mm-hmm. Ride the roller coaster. Don't get off in the middle. You know what I mean? That's just a good analogy. But again, so important. This is why these conversations are important. I was actually, small plug, we have a Social Security seminar October 6th, but I was calling people for RSVPs, and I could tell some people were like asking for meetings. I'm like, well, what do you need? Like, not that we don't want it, but what would you like to discuss at the meeting? And I could just almost feel like they want to talk about the market. Should I do something different? And it just speaks volume of why it's important to walk alongside a financial advisor, especially during a bear market.
Yeah, for sure.
Cole, not to age you here, but Bailey and I've been through a couple, short down market cycles, but you're probably the only one that's really seen a true, multi-year, economy, all kinds of different things going on. So I know you had some experience. You've told us some stories about when you were at Principal, in the 401k department, dealing with client service. So tell us a little bit about that time. I know you kind of got
I'm getting
grin.
a little red because, probably 2008, 2009, you guys weren't in the investment business. But
high school.
I graduated high school. Oh wait. Shout out.
So I was at principal, and we had a lot of people freaking out for good reasons. It was a lot worse than right now. For the Dow, for example, had hit 14,000 in 2007, and in March of 2009, the Dow was below 6,000. So it had lost more than 50%.
Yeah.
So when you think about 25% what we're dealing with right now, that's not even close to what was going on here. And I had people calling into the 401k department. We had 150 people on hold. I mean, it was just a nuts time, and it was really educational to talk to people in that time, because they were not upset. They were very upset, but they also didn't know what was going on. I mean, it was just such uncertainty, and the market hates uncertainty. I've probably said that several times. So what people would do is they'd call in and talk to the 401k, and some people I'd be like, okay, well, you're 27, you have $10,000 in your account. Yes, I understand it's only worth $4,500 right now, because it dropped from 10,000 to 4,500. But are you planning to use this money anytime soon? Well, no. Okay, well, typically markets turn around in a couple of years, and you should keep investing. You're buying things at a lower price, and you haven't actually lost money, quote unquote, until you sell the shares that you have of your mutual funds or whatever you have in your 401k. And some people would get it, and some people would be like, okay, so I should just leave everything as is and just let it go. And that for someone in that age range, that's what they should have done in that time period. But I did have people that would call in and be like, I can't handle this. I can't, I've seen my account drop from 50,000 to 22,000, and I just can't take it. Just sell it all, put it in the money market. Well, if you would have done that in March of 2009, your account would probably have doubled, probably not even doubled since then. Instead, sit in the money market, and if it would have stayed in the stock market, it would have tripled or quadrupled by now. So it's all about where you're at in the process and what you need to accomplish in the next 1, 2, 10, 20 years. These people, most of them were long-term investors, but I did have to talk to people that were getting close to retirement.
Yeah, I was just going to say very situational. I was going to pivot and say, what about someone who's getting ready to retire?
Well, and that's where, if you're over the age of 59 and a half and you're going to retire, say at 62 or 65, you shouldn't have been 100% in the market. And I didn't tell people that because that wasn't my job. But at the same time, I'd be like, well, all of your investments are in the stock market, and the stock market's down. I apologize, but especially if you're looking to retire anytime soon, you're going to maybe have to wait it out and wait for the market to come back. So, and not everyone was in that position. Also, another common misconception with 401ks is they think that 100% of their account is in the market, in the stock market. And if you worked with a financial advisor and you've gotten ready for retirement, typically they're not going to have all of your account in the stock market. They're going to have some in bonds, some maybe in a fixed interest rate or money market or something like that.
Yeah, that's one of the, it makes me cringe, when I maybe get a new client or someone and we start educating on different options maybe available in their 401k or things, and they're like, gosh, I wish I would have known that was even an option. Just like you talking about non-qualified accounts and people know. And a lot of times it's people don't know until they have that conversation or seek out. So yeah, I mean, great example, very real life, example. And obviously, hopefully we don't go to that extent, but again, it's part of, there's positives and negatives of every market situation, and you're going to make the most out of it based on your situation and having a plan.
I agree. Because, we've sat down, and it just like you said, it's education. People don't even know what options they have in their 401k. Nope. How many meetings have we been like, I haven't looked at it. I'm not sure what I am. I just went with what my coworker was in, which, again,
not a valid investment strategy.
Yeah. That's why we work with professionals. That's why NFLs have coaches, Everyone needs that person to guide them. But, yeah. That is a bear market. Anything else you guys want to add to that?
Well, just in my opinion, the 2008 recession, there was a lot going on that was bad in the just economy and the world with the housing recession. So right now, in my opinion, fundamentally, there's nothing wrong with the United States or the markets in general. Of course, there are some issues, but the housing recession was, and banks were going out of business, and things were way worse than they are right now. Rising interest rates and inflation are not reasons for us, I believe, that we're going to see a major downturn like we did in 2008.
Correct.
The private sector is in a much better spot than it was in 2008. I mean, that's
Correct.
a huge difference versus, we've got some, whatever side you're on, governmental issues, probably inflation things there, but individual households are still, doing really strong. And, our private businesses are still, very, very strong. So I think, I'm an optimist I'm an optimist. I'm a half full guy at all times. And I think, I like that. If 1 year from now, I think we're going to be better. Are we at all-time highs? Who knows? But I think we'll be much better than we are now, and it'll be a little more clear picture for us. So I think, we say one thing: stay positive out there, even through tough times, and make sure you're having the conversations.
Yeah, I think we are seeing volatility, not a recession. So that's just my opinion.
And remember, none of us have a crystal ball. Cole does on his desk, but
It doesn't
work.
it doesn't work. It's
very well.
broke. But
Will the Broncos win the Super Bowl?
Yeah. But you know what? It's an emotional thing. We understand that. It's very emotional. People just need educated. People need someone to just sometimes talk them through it. So I think that's what you guys do a really great job of. A couple things. Again, Social Security event, seminar, October 6th at the Starlight. You can
6 o'clock.
6 o'clock, free dinner. You can RSVP online. It's always a good time. Social.
Or call the office.
Yeah.
Yep.
Call Emily Q. Shout out. But yeah, that's what I got.
All right, guys.
Share,
share the podcast. Caleb, tell them.
Yep. Like it, share it, subscribe on all podcasting platforms. It's now on YouTube as well. Follow these guys on their social media.
Facebook,
LinkedIn, Twitter. And visit their website for any questions. Send them a message. They're there to help you.
Perfect.
That's a wrap.
Make it a great week.
Go Cubs.
You've been listening to How to Money with Cole and Cole, the podcast of Essential Financial Group, courtesy of Spin Market. Learn more about the Central Financial Group on their website, www.centralfinancialgroup.com.
For now, I'm Cole.
And I'm Cole.
And we'll see you on the greens.
Securities and investment advisory services offered through Royal Alliance Associations Incorporated, member FINRA, SIPC. Royal Alliance Associations Incorporated is separately owned, and other entities and or marketing names, products, or services referenced here are independent of Royal Alliance Associations Incorporated. Material discussed is meant for general informational purposes only, and it is not to be construed as tax, legal, or investment advice. Please note that individual situations can vary. Therefore, the information should be relied upon when coordinated with individual professional advice. Past performance is no guarantee of future results. Diversification does not insure against loss. Any guarantees discussed refer only to fixed insurance products and are backed by the financial strength and claims paying ability of the issuing insurance company.